let's get right to today's action. We have Mark Tepper. He is Strategic Wealth Partners CEO and founder with 3 companies he says you should get in on. And Larry Shover joining us now from the pits of the CME. Larry, I want to start with you. And let's start about earnings overall. What do you think of the season so far?
Well, the season has been great, and as you mentioned, we're at the peak right now of the micro season. We've had on the earnings side, S&P 500 is beaten by over 70%. On the sales side, it's been over 50%. That's been stunning, and I do believe that's what's kept the market up. Now, David, it's important to recognize the last few days, it's been a little bit lackluster, especially the last 12 hours with Europe and with the U.S. having some, kind of flat earnings. That's kept the lid on the stock market. But overall, we have remained higher because earnings season has been very, very good.
Okay, earnings have been good, but not the best that we've seen in the past 4 quarters. So what do you think happens next? And is there a particular sector where you see a lot of flows on that floor?
Well, the flows that we're seeing right now, financials, healthcare. I mean, think of all the financials in the S&P 500. They've beaten by 80%.
And I'm interrupting you, Larry, because
Sure.
there are the big ones. There are the big money center banks, and then there are the PNCs of the world and the Bank of New York Mellons. All of them?
Yeah, absolutely. Yeah, I specifically look at the bigger banks, the bigger money centers, the ones that are going to do much better with higher interest rates.
Okay, hold on one second, Larry. Poor Larry, I'm interrupting him again. We've got Amazon numbers right now. Dennis Neal.
Yes, Liz, and the Amazon numbers are bad. The stock's already down 5% after hours. Revenue meets Wall Street expectations, $15.7 billion, although Wall Street wanted $0.73. I don't know if it hit that. But the bad thing is the bottom line is a loss of 2 cents a share instead of a profit of 5 cents a share that Wall Street was looking for. And as well, Amazon says in the coming third quarter, it's going to have an operating loss of close to $500 million or as little as $65 million. And it also says that revenue growth in the upcoming third quarter could be as low as 12%. The revenue growth in this third quarter just reported was 22%. The revenue growth in the year ago second quarter was 29%. We got to see how Wall Street responds, though, because Wall Street is kind of patient with Amazon and figures it's building the biggest store in the world. So we'll bet on it for the longer term.
Wow. They're not keeping their worldwide shipping costs down. In fact, they're higher this time around over the past year. That was something people were watching.
Let me go to Mark Tepper, because, Mark, you had as your first sentence in the notes that you had about Amazon that you sent us beforehand, you said it wouldn't be a surprise if they were to miss their estimates. You were right on the mark. Why did you think that was going to happen?
You know, this would now be, 4 out of the last 5 quarters where they've missed on their earnings estimates. And they've been pretty blunt about saying, really ever since their IPO, that they're not going to manage the company for earnings. And, I really just expected that they'd probably miss again. And when you look at the stock price, even though they've missed 3 out of the past 4 quarters, now 4 out of the past 5, the stock price has still done extremely well. So I really think that, for a lot of investors who are interested in a company like this with such a rich multiple, it's probably going to prove to be a good buying opportunity. But for us as a firm, that multiple is just really a bit too rich for us.
Larry, it's all very nice to be marching to the beat of a different drum and say we're not going to manage it for earnings. But you also have an extremely rich price-to-earnings ratio of about 230 here. Do people finally stop believing as strongly in this stock? Although right now you're looking at a bid and an ask that's, hold on, I can't quite see there. It sold off initially, but it's not that bad right now.
That's amazing when you think about it. Options traders have been very bearish when you look at the skew of the options, the implied volatility. I think people are starting to give up. It's a very, very risky trade. You're right. I mean, e-commerce, it's the way of the world. It's going along quite well in the U.S. It is suffering in Korea and in Europe for sure. But the fact of the matter is they are the world leader, the biggest retailing shop in the world. But revenue is what's really important right now. They're spending so much money on different things, including Kindle and all the other things that they're doing that weighs so heavily on their margins. So at the end of the day, it's revenue that you have to look at more than anything else. At the bottom line, though, I do think the stock is really fat. I think it's very, very risky to buy that stock without hedging with options.
Although, let me just say something about their PE ratio. Mark, I'll throw this back to you because you were worried about it being over 200. You know Facebook, how well it is doing today. It is up, way up today. Do you know what its PE ratio is? 1,735. So it is possible for a stock to do very well with a high PE ratio, one even higher, much higher than what Amazon has.
Sure, yeah. I mean, that's definitely possible. I think the big difference between Facebook and Amazon is really the deal that Facebook has really such significant growth opportunities with them finally being able to figure out how to monetize some of the, the mobile users.
Let me talk about the opportunities for Starbucks right now. We got earnings coming in. Ashley Webster, you got the earnings? Go ahead.
Yes, I do, David. Thank you. On the EPS earnings per share, we have 55 cents. This is third quarter results for Starbucks. That beats the EPS estimates by 2 cents. On the revenue side, essentially what was expected, $3.7 billion. The actual estimate was for $3.72 billion. Global comparable store sales, the estimate for this was around 5 to 6%, actually coming in up 8%. So a lot of encouraging numbers here. We're just digging in more. We're looking at the revenue growth projection for next year from Starbucks, anywhere from 10 to 13%, which is, again, on the upper end of estimates. So
that may be why we're seeing a beat after hours. Larry Shover, it ended the day at $68 and change. Now it's up over $71 after hours. Is it going to stick to that tomorrow?
I think it will, and I think it's going to continue. Everybody talks about the great growth potential in Latin America and Asia. I say that's great. That's a kicker. To me, I'm surprised by the U.S. growth. I mean, they've made some very smart acquisitions, inexpensive acquisitions, Tivana, Evolutionary Fresh, etc. Look what they've done down the consumer aisle with K-Cups, with Via. Via took 5 to 10 years in the process without compromising their brand. Commodity prices are also cheaper. That's going to help the company. So I like the company. I think it's valued quite cheaply compared to its competitors.
Hey, and as long as Howard Schultz, the founder, is back as CEO, Mark, that has been a real win for this company since he took the reins once again. David and I remember during the financial crisis, this was an $8 stock. Look at it now, $68. And, of course, they were closing 600 U.S. stores. Now they've reopened most of them. They're just really running on all cylinders, are they not?
Oh, yeah, absolutely. I mean, this is one of the best companies that's out there, one of the best brands in the entire world, and they're going to continue to experience good revenue growth for, I would say, the next decade or so. Now, they're not going to see 20%, 30% growth year over year anymore, but low to mid-teens, 10 to 13%, as they just said, would still be very solid growth, and I think it's a good play for, at least the next decade.
Okay, let's go back to Dennis Neal for a second. He's been pouring through those numbers that are coming out on Amazon. One thing really shouted out at you. What is it, Dennis?
Well, you know what? If you look at it, this company has amazing cash flow going on. The problem is not enough of it is turning into operating earnings, and even less of it is turning into free cash flow to fund future expansion. Couple numbers for you, all right? Operating income in the second quarter just reported down 26% versus a year ago to only $80 million or so. Now, operating cash flow up 40% in the past 12 months versus a year ago period to $4.5 billion. But the problem is free cash flow. This is the money a company has left over after they take depreciation and spend money expanding plants and factories. Free cash flow for the past 12 months comes in at $265 million. Guys, that is down from $1.1 billion in the previous 12-month period. So free cash flow, how much money Amazon has left over after it funds its expansion, has plunged. And I just wonder what the heck that means.
And Larry, when you see $15 billion in revenue and such little cash flow, I mean, you got to wonder whether Bezos has the right strategy. I know he's trying to build for the future, but will Wall Street stick with him as he tries to do so?
Well, Wall Street might stick with them. Maybe it's a $300 stock. Maybe that's why it's priced at $300. But the risk to go to $300 to $350 is absolutely enormous compared to the downside. I mean, another thing we have to look at is that the growth of the company is continuing to decelerate. Sorry about that. And when is that going to stop? I mean, it's problematic. The price is $300. It's a very rich stock given everything else out there. Long term, a great company. They're spending a lot of money. I would stay away from it unless you hedge with options.
Well, they're going into a lot of media. That's something Dennis is looking at as well. Just want to quickly mention, as we pick through the Zynga numbers and try and clean them up at the moment, Zynga's daily active users, Ashley, has apparently gone down. That cannot be a good sign.
No, it's not a good sign. In fact, the daily active users numbers year over year are down considerably, 25%. Same story on the monthly active users. And we're also looking at the bookings for the second quarter. This is a key indicator of revenue growth, and that came in at 188 million, Liz. That is down 31%. So the numbers here on the EPS, we have a loss of 1 cent per share. That's better. We're expecting the estimate was for a loss of 4 cents. On the revenue side, coming in around $188 million. That is better than the 183 or so million revenue estimated. So better on the top and bottom lines, but we dig into these numbers and it's showing a decline in many of the key areas.
All right. Larry, a final comment from you, and I want to focus on market analysts. We've been battering this back and forth here at FBN, but all these snide market analysts who were saying that Apple is worth $800 right until Apple had disappointed on the earnings, and then they did the opposite with Facebook. They said Facebook would never make the earnings. They made the earnings. Now the analysts come out and say, okay, we should have put our estimates higher. These analysts get it wrong, it seems, more often than right.
You're exactly right. And the Fox faithful need to hear this. We're surrounded by this grand notion of randomness. And an analyst, a trader behind me, knows no more than somebody that's watching the television right now. That is the truth. We might have an educated guess, but at the end of the day, we just don't know what we don't know. And so what that means is be conservative and be well-balanced and diversified in your portfolio. Don't listen to one person for all your investment advice.
Which is why you got to keep it here on Fox Business, because we provide all of the analysis that you need to make the right decisions.
Larry Shover, Mark Tepper, we thank you very much. Amazon's